Welcome to Jazz After Dark, special late edition. If you haven't figured this out yet, I record these at night in my house here, and it is what time is it? It is 11:30 at night. So we'll be enjoying this week's selection, the Bullet Bourbon, Kentucky-based. Very, very good. I hope you got a drink. Come hang out with me a little bit, and let's see what we can learn. It is late, so we'll go a little light on it. Also got this fancy glass here. I've got a couple of these, actually. You put the little cigar thing there. Finish up a late night. The little Bullet Bourbon and an Aladino, by the way. Anybody that is fancy enough. Aladino, great cigar. Pure Corojo from the 60s. And Bullet Bourbon, if you're not familiar, you get your honey, you get a good amount of spice, light on the oak. Honey's probably a good way to say it. It's a little sweeter than a Buffalo Trace. Ranks up there for me. I would give it a probably like a 82, 83, if you could rank it there. Good one there. Anyways, welcome. We're going to talk about asset-based lending or securities-based lending. If it's your first time joining us, this is very laid back, a little bit different than what we normally do. The goal is to just hang out, you know what I mean? Wrap up the day with a little bit of knowledge. But this is becoming more and more popular, something we've done for clients for a long time. But asset-based lending, or we'll just say securities-based lending, is something that's typically reserved for the wealthy. And what I'm going to share with you tonight is an actual example that we used to share when we would have to teach wealthy clients. If you're not familiar with my background, I used to work with wealthy clients that were based in China, and so they would come to the U.S. to learn how to invest their money over here when they were allowed to. And so we would have to educate them as well. And that's why my background is more in education of the stock markets and products and things like that. So we're going to do that. But basically, a really simple way to explain it is securities-based lending is to recognize that one's stocks, ETFs or whatever, are an asset. And if we're going to count them as an asset, can you not borrow against your assets? You may be familiar with your house as an asset, and you can have a line of credit against your house. You don't have to, but it's there for you. Well, this is very common for people with large amounts of brokerage accounts or maybe long-term stock holdings that they've had. And the reason that someone would want to borrow against their stock can be for future investments. Maybe they have other reasons to invest in an opportunity, but their stock is tied up or their money is tied up in a stock. It could be strategic, where they find that the cost for them to borrow against their stock is greater than actually using the cash that would result from them selling their stock. So that's a little tougher these days because of the rates that are charged, but it could be that. Or it could be purely for tax advantages. If you don't have to sell a stock, let's say you need some money and you normally would sell a stock and go do your thing. Well, what if that stock has a capital gain? Well, then you'd have to pay tax. And so I'll go over an example with you. Now, the example I'm going to give you here tonight, keep in mind, I know this isn't everybody. This is the example I used to give. Just take a few zeros off. It's really, just how it works. Let's dive into it. I don't know why this says this here. We can get rid of all this. Don't pay any attention to the name of this slide. It is definitely not true. That's going to bug me. I'm sorry. That's just going to bug the living daylight out of me. There's nothing I can do about it. Okay, let's go back. So let's present a scenario here where you have a lot of money. And again, just take some zeros off. This doesn't have to mean you need this much money to do this. Scenario number one is where we need some money and we're going to go the traditional route. We're just going to sell our stock. So we have $5 million in our brokerage account. We need 1 million or something around there. And so we sell it. Well, I don't know if you know, but in that area of life, when you have that sizable taxable gain, it is taxable at 20%, even if it's long-term. And that's actually preferred, long-term capital gain. So we've got taxes of $200,000. So we sold off $1 million. We have taxes of $200,000. We have $800,000 in cash. Wow. So let's give an example. We want to buy an apartment building or invest in an apartment building or something, right? So we need some money. So traditionally you do that. You say, okay, I've got 800,000. My portfolio is now worth 4 million because I started with 5. I had to sell off 1 million. The government got 200,000. I kept 8. And so my portfolio has 400,000. If the portfolio grew at 6%, you'd have a $240,000 gain. Again, just take the zeros off, right? This is just an example. And we don't have a line of credit, so there's no interest due, which means we would make $240,000 if we assume that over the next year we made 6%. So in other words, we got to take our million out, and basically at the end of the day, we made back our tax money after 1 year. Our portfolio value is $4,240,000. So that's scenario number 1. Does that sound familiar? You've likely done that, maybe not with 5 million, but you've sold stock, paid your tax. Maybe it's less, but you paid your tax, you took your cash, and you did whatever it is you want to do with your cash. Scenario number 2 is they say, well, let's be smart about this. I'm going to take out a line of credit. So my portfolio is still worth $5 million. I don't have to sell anything because I'm just going to borrow against it, which means I'll have no tax, and I won't actually have any of my own money coming out. So my portfolio in this case is worth 5 million. Over here, we took 1 million out, so it's worth 4. If that same portfolio earns 6%, we have a $300,000 return versus $240,000. The interest to borrow against your account, by the way, does cost money. So we're saying, okay, well, this interest costs us $40,000 for the year. And so realistically, we made 300 in growth. We have interest that we've had to pay throughout the year. And so our net gain is 260. The difference is our portfolio value is now $5,260,000 because we had to pay some interest. Would you rather pay tax or would you rather pay interest? But now you don't get to keep this. You don't get to do anything, or you don't get to, somehow get away with this, right? If you came to me and I had, let's say you're with us here at Jazz Wealth and you have $100,000 in your account, and I'm going to let you borrow $50,000, $60,000, whatever it is you need. Well, I'm taking a risk, right? And I'm not taking a big risk because I have your $100,000 in your account. And so historically, it doesn't cost you a lot to borrow against your account. Now, thanks to the Fed and interest rates going up 100%, it does cost more to do that at this moment in time. But like your home, the interest rate is variable. So the rates can be lower, they can be higher. You're just typically paying a spread between that and the federal funds rate. The point of the story is, in scenario number 1, we had to give up $200,000 in taxes. Scenario number 2, we didn't give up anything besides the $40,000 in interest, which means our portfolio is worth literally $1 million plus what we would normally have to do. And so that is the way we used to explain it. I've updated it for the tax rates, but that's the way we used to have to explain it so that a client could really easily understand, I need $1 million. I need to take it out. Let us let you borrow it and you avoid the tax. Your stock remains in place. Right? And so the logistics of this are that it's a line of credit. It's not a loan. So all you have to do is pay the interest back. Now, at some point, let's pretend it was 2022 again. The stock market could have fallen. And maybe you look at your portfolio and say, if I were to sell off stock now, I wouldn't have a capital gain. And so you lose that potential tax consequence. Now you had 5 million, you take $1 million out. Let's say there was no tax consequence. We still have 4 million. And so if it grew 6%, 240,000, you still end up with less, even if you back out the fact that maybe you didn't have a capital gain. Remember, because your entire portfolio gets to grow. So take some zeros off of it, look at it from your perspective, or add some zeros to it, and you can really quickly see how that's a huge advantage. Naturally, it's a huge advantage to the wealthy, but it's becoming more and more popular for the average person to be able to do it. And typically when I explain this to clients, they think, something shady about that. That's normal, believe it or not. Even when we would talk to people whose net worth was $40 million, they still think somehow you're getting over on us or something's happening. So you really have to just break it down and go, is it better for me to take the money or temporarily borrow against it. Like I said, right now, hey, same as your house. If you were to take a line of credit against your house, the rate is going to be much higher than it was a year ago. That's just a product of the Fed. Once all that settles down, it will cost you less to borrow against, have a line of credit against your house. And same with your securities-based lending if you choose to do it. Now, those of you that are watching and maybe clients of ours, the IRS is very clear that you have to have at least $100,000 in your brokerage account. These companies that are saying like put $1,000 in and we'll let you borrow some of the margin, that's different. That's a little bit different. That's more costly and a little bit more dangerous because the margin requirements are tighter. Maybe that'd be a separate video there. But to truly borrow against your assets, you have to have $100,000 in a brokerage account. Also, I want to point out, this doesn't work in IRAs. It doesn't work in Roth IRAs. You can kind of do it in your 401k, but you can't say, well, I have $2 million in my Roth, but I don't really have any cash. Let me borrow against that. It's not the same. That's not allowed. So this is only for brokerage accounts, individual accounts, joint accounts, things where you just have cash that's been building up for whatever reason, and you want to borrow instead. We've done this numerous times for clients that have been buying property. Because let me take it a step further. You got a second? Let me take it a step further. Hold on a second. That's good. Let's go back for a second. This is the geeky side of it. All right, we know it costs you $40,000 to borrow in interest. Could we, now this is assuming the return off of 6%. We're assuming that you were able to get that return. But we know that the markets, maybe they don't give you 6% next year. That's in a perfect world, right? So let's pretend that in this case, we could make $40,000 in interest. Now that's taxable, of course, or potentially taxable depending on how you get it. But let's say that you borrow $1 million. I'm just take the numbers out. You have $500,000, right? A little more realistic. And you borrow $100,000. The $500 is still invested. And let's say it costs you 7%, right, to borrow. How much interest are you going to pay off of that in a year? 7%, right? So I'm going to pay $7,000. Could we not go generate dividends in the amount of 7%? Sure. So you pay interest of 7%, you get dividends, or we could structure something there so that you end up getting back dividends and interest of 7%. So you borrow the $100,000 for $0. As the dividend comes in, the dividend pays the interest, right? That's where the nuts and bolts of this really start to take shape. Because if you're someone who's really wealthy, you got $10 million and you borrow $1 million, we don't have to take all your investments and try to turn it into generating a dividend to pay off the interest. Only a piece of your account has to generate that interest, right? So if you had 10 million, you borrow $1 million, the 10 million that stays there, we don't have to change a lot there. You only borrowed $1 million, or 1/10 of your account size. Therefore, 1/10 of your account has to generate enough in dividends to pay back the interest. If you could do that, which you can easily do these days, then now you're borrowing against yourself for free. You can't say that about a home equity loan, or I'm sorry, home equity line of credit, right? If it costs you 6% to borrow against your home, unless you're investing it in something that can generate that, you're not getting it. In this case, we're saying you have the assets of X and you're borrowing some of it to go do whatever you want with it. But the assets still here can generate that return for you, the interest to pay off, or the dividends to pay off the interest. So there's an extra layer there. And I only went there because I've been saying 2023, we need to go the extra layer. So I went a little extra layer deep for you. Any client that does that with me, that's the first thing I start promoting is, well, look, if you're going to borrow against the account, let me try to help make this cost nothing. It's getting incredibly hard now with interest rates being so high, but it can still absolutely be done. It just has to, make sense for what you're trying to do. Okay. Did you enjoy our time here together? Have you enjoyed these Jazz After Darks? I see mostly positive feedback there, but Keep in mind, I don't drink every night, right? It looks that way because I'm making videos, but pay close attention. Also, pay attention to how many times the glass is actually empty. I'm a bit of a lightweight. I do like to sample various bourbons and stuff, but I'm a bit of a lightweight there. So please don't think I just sit around here at, now midnight doing this. I guess that's my time to get out of here. All right, you guys enjoy the rest of your evening. See you tomorrow night.